Hey, Karen Wright, real estate agent, Wichita, Kansas. So today we'll be talking about how much you can afford when buying a home. You'll need to know this information when you start working with an agent because they'll be like, "Hey, what's your price range?" So let's. This video is basically to kind of look at costs in buying a home and what you can afford based on your income, etc. So first we'll go over a quick calculation. Next we'll discuss getting a pre-approval. And then later on, we'll talk about the fees involved in the closing costs. Those are big questions that a lot of buyers have during the start of looking at a home. So with that, let's get started. So first, we've got the 28-36 rule. It's basically a simple guide for affordability. And it's easy to calculate. Just multiply your gross monthly income. So first of all, figure out what your gross monthly income is, or you and your spouse, if you're buying it together, or girlfriend, boyfriend, whatever. Multiply that by 28% is a number. So if your gross monthly income before taxes are taken out is $6,000, let's say, to do an example, multiply that by 28% or 0.28, and you come up with 1,680. So that kind of gives you that first number. So, most likely you want to kind of stay at that number or really below. And definitely lenders are using these numbers, by the way. So this just gives you like a quick calculation. Hey, what's my gross monthly times 0.28? There's also a debt to income ratio that you'll hear everybody talking about, the lenders. So you add your expenses like credit cards, student loan, car loan, and your hopefully soon to be mortgage, or what you think it's going to be, or kind of calculate it based on what your rent is right now, but add those up, not your utilities and all that. I know this gets kind of complex, but not the other bills, but these are the main ones to be looking at in your debt to income ratio. So add those up and divide by your monthly gross income. So experts say 36% is the maximum you can afford. This scenario actually comes up to 36% with the credit card, the student loan, all those numbers added up in the mortgage or rent, and divided that, it does come up to 36%. So it can come to 35, 34, 33, but whatever comes up, but they say 36% is the maximum. If you go past this percentage, it's just starting to get extremely risky. So kind of stay between under 28 and then really stay below 36. Unless you have other scenarios like another significant other that's not on the loan and they can add more, but those are other variables. So these are two numbers you should become familiar with. Your lender, like I said earlier, will definitely be calculating these. So once you know these numbers and determine your down payment, so are you 3%, 5%, 10%, 20%, but whatever number that is that you've been saving up, hopefully you've been saving up. If not, you have to do a quick save or pull it out of your IRA, 401k type thing. But you'll have a much better idea of what mortgage payments you can work with. And don't forget, you can play with the online mortgage calculators, keep changing your price point, your down payment, interest rates. You kind of have an idea of where those are at right now. It's about 2.8, kind of creeping up around that. So next, let's talk about the pre-approval. This will get you a sense of how much you can afford with more details. The lender will pull the sources of what you're telling them your income is, your assets, what's in your bank statements, stuff like that. But they will pull the verification sources. So it's better than a pre-qualification. And it'll kind of determine your financial landscape and basically what they're willing to lend you based on your financial situation. And a common question, like I just mentioned, what's the difference between a pre-qualification and a pre-approval? Pre-qualification is really just taking your word on your income, what you owe, student loan, car debt, stuff like that, without verifying the sources, where a pre-approval is actually the lender validating all the information that you have told them they go directly to the third party sources and verify the income, credit score, etc. So it's much stronger, and if a seller knows you have a pre-approval, that their agent will let them know, no, that's very strong. You'll have less issues that might arise down the road. And lastly, let's talk about closing costs and all that falls into place for closing costs. First of all, they can run about 2 to 7% of a home's purchase price. Yes, that's a wide range, and it varies, and that's why working with different lenders gives you different numbers. Sometimes the seller can help pay some of the closing cost fees. This comes up during negotiation to where the buyer can ask them to pay for some of the closing costs. It just depends on a lot of other variables. So anyways, let's go over some of these fees. Loan originator fee. So this is what the lender is charging for the processing of the paperwork of your loan. It takes hiring somebody to do all that. Your credit report. You'll have a fee for the credit report to see how you've been handling your credit. There's also a fee for the underwriter, and that's the person that's assessing your credit worthiness with pulling all your information together. There will also be an appraisal fee, and this, of course, is, the bank wants to validate that the value of the house is worth what they're lending to you, and which will be collateral. And there's an inspection fee. Now, the inspection fee the buyer tends to pay during the transaction. They just pay straight to the inspector that they choose, and they'll have termites done at the same time, typically. But again, that falls into what we consider closing costs. And of course, they evaluate the condition that the home's in, how's the roof, how's the siding, the mechanics in there, etc. A title search fee is done, and that's to check to see if there's any liens on the property. If somebody comes and is worked on that person's house and they didn't pay them, the only way that they can do is go down the court or the city and put a lien on the house, and so that it needs to be taken care of basically before transferring a home. So that's what the title fees are for. And a survey, if a buyer wishes to conduct a survey, that is also part of the closing fees. And funny enough, boundary issues do come up enough. It seems like whenever I stick my listing sign in a property, if the neighbor has a boundary issue, I'm the first one they call. They don't want to seem to work with the homeowner. So had several of those in the last couple of years. So a survey is another fee that could be part of the closing costs. So as an agent, I always ask my buyer to reach out to their lender to put an estimate together on the house they plan to purchase. We do need signatures on that with my company, and so I go straight to the lender because those are more exact costs on that exact property. Literally the night that I'm putting the offer together, I'm like, look, you got to get that to us, because they deserve the right to know every fee that's coming up. I mean, a lot of times we're in a hurry at the end, especially right now with these multiple offers coming in. So it is, getting the lender to, hey, throw those fees together as quickly as possible so the buyer knows exactly all the fees for this particular house that we're about to put an offer on. And again, as an agent, I do need them to sign that. And this will include like HOA fees and taxes with that particular house. So that kind of gives you what you can afford. So let's just kind of recap right now what we talked about in this video as far as knowing how much you can afford. First, we discussed the 28-36 rule. Those are just overviews to estimate on how much you can afford and what not to go over in paying for a monthly mortgage. Second, we talked about getting a pre-approval from a lender so you know what you are qualified for with data to validate and back up your assets, your income, all that information. And lastly, we talked about closing costs and each fee that makes up the closing costs. So with that said, you will need to have enough money in the bank for closing costs and your down payment. So it's good to study up on this and talk to your lender and an experienced real estate agent so you really know your numbers going into it. It's a process, and it is a lot of numbers. So I hope this video has helped. And like I mentioned before, sellers can help with closing costs if you negotiate that into the offer. Relatives can help with a down payment as long as a letter is written to the lender that states the buyer does not have to pay that back. So there you have it. Everything you need to know, or enough that you need to know at this point on what it costs to buy a house. So I hope you enjoyed this. Please, if you liked what you saw, make sure to subscribe to get all the other information tips in my other videos, and ring the bell, and hey, reach out anytime. I'm happy to help with any questions on anything real estate related. So thanks for watching. Have a great day.